Hi everyone. I'm just today talking about portfolio management. So the concept of portfolio management and it starts where the security analysis are ends. So the fact has important consequences for the investors. So when the investor has want to go for extensive investments in their investments, this is the best option when they're choosing the portfolio management. In this way, they're reducing off their risk even they have a possibility to increase the more number of profits for their investments. So the portfolio is simply talking about the combination of securities may or may not take the aggregate characters of their individual parts. Even portfolio is a combination of lot of properties. Some properties are physical, some properties are not physical, some are financial. There are multiple types of properties are involved for their investment, but when you taking the result analysis from the portfolio, all portfolio properties are should be end at a particular time period only, then only it is possible to summarize the result of the portfolio. So when you see that the image, there are so many product are has in the glance of a portfolio. So the process of blending together the broad asset classes so as to obtain optimum returns from their investments, and the minimum risk is for the that portfolio it's mandatory. That is a major objective of the every investors in the society. So the diversification of investments helps to spread risk over many assets. So the earlier there is no spreading of their investments. The investment is belongs to only one part or single property of investment. But after the portfolio concept, the risk has been diversified because of the investment diversified. So a diversification of securities gives the assurance of obtaining the anticipated return on the portfolio. So in a diversified portfolio, some securities may not be perform well as we expected, but others may exceed the expectations and making the actual return of the portfolio reasonably close to the anticipated one. So, but we don't know, but most number of the time, every investor try to be uncertain in certainty of environment only, but the real environment comes to the uncertainty also. If you see that image, there are so many investment baskets. So that is the equity, debt, and even others. So how much the amount you are investing, that will be discussed and later. So the same thing, what kind of properties you are choosing also the purely depends on the investor nature and objective. So the keeping a portfolio of single security may lead to a greater likelihood of an actual return, somewhat different from that of the expected return. Hence, it is a common practice to diversify securities in the portfolio. So an investor can sometimes reduce the portfolio risk by adding another security also. It is possible only when you are evaluate the portfolios. Even the individual risk, then maybe other securities in the portfolio. Why the investor is going to be keep on changing because of to reduce the risk, even they want to increase the profit of that portfolio. So importance of portfolio management, of course the risk and return are the most crucial aspects of financial planning of every individual investor, even the organizations also. In the organization as the investors of a single person, all are the major agenda is to minimize the risk and maximize the extended possibility in the general environment. So the lower risk will provide you the lower return, even higher risk will provide you the higher return. But in the expectation from the investor point of view, they will expect the higher return with lowest return, either lowest risk for the highest return. The best portfolio management runs on the minimum risk and maximum return of the investors in a given time frame. I already told you the time is very important when you go to dealing with the portfolio. All property should be end and begin with the same timing. So when you go to that objective or process of portfolio, the first one you need to check out the better investment planning. So at a look at a look a look at your past investment will help you frame a better investment strategy in the near future. Even you can also plan holistical while uh, considering the investments, that is age factor, risk involvement in the property, and income, budget of the employees, all are going to be the uh, parts of the when parts to planning of your investment program. So the finale, making an informed and a productive decision will help to reduce the likelihood of losses. So the next one minimizes the risk. Of course, I already told you so many times, minimization risk, complete avoiding of risk is highly impossible, but every investor try to reduce the risk some part. Even if you go to the portfolio management, helps reduce the investment strategy risk to extent that cannot be ignored. As a result, it enhance the likelihood of profits. Even though risk is minimized, the portfolio manager consider uncertainties such as critical illness, payment disabilities, even the death also. Therefore, investing in risk assessment financial tool likely. So generally, every investor will eliminate the risk by using the insurance. So, and this will be definitely provide you the risk-free properties, risk-free assets to the organization. Now we are talking about the customized solution. So the portfolio management allows you to plan and account for specific goals as well as adapt your methods, expected returns, and risk based on your performances preferences only. So if you see that, the next one is the tax planning. So taxes typically deleted your income or depleted. So even sometimes you may be not get the money. So hence people prefer to avoid paying the any more taxes in generally, but in some investments in portfolio will definitely provide you the reduction of your tax rates. And the next one, reduce the cost and saves time. So when you're using the portfolio management process, the investors may lack a solid financial foundation. So due to that, they're depending on their managers to get the specialities of their work. So still others may be struggle to follow the factor influencing their investment. So therefore, the management managing personal finance and not doing it for the right way can be costly. So this is why availing of portfolio management services come with a cost and goes a long way in protecting the individual's property. Now we are talking about objectives of portfolio management. Fundamental objective of any portfolio management is to help select the best investment options as per one's income, age, time horizon, and risk appetite. So if you think that this is the combination keep on changing whenever the investor comes, the portfolio manager need to understand the profile of the investor and then only they'll go for the investment. So the whatever it is, they need to keep the mind what are their income, what are their age and the time period, what is their aptitude, and how much the risk are ready to bearing that. These are all are the points relating to when you're constructing the objective. But the different objectives come here when you are in the future. If you think that the employees, that means the investors point of view, so what is their main motto to invest in portfolio or construction of portfolio? See that some people come here capital appreciation, some may be reduction of their risk, some may be maximizing of their returns, some may be taking off performance of their portfolio by changing the properties, and some may be using of optimum allocation of their money, that means a resource. And some there are so many points are there, but here we are talking about only few. So the types of portfolio management, in a broader sense, portfolio management can be classified under four major types. The first one is active portfolio management. This type of portfolio management calls for high level of expertise in stock market, Why I'm telling that? Because the portfolio is actively involved in buying and selling. So the stocks frequently buying and frequently selling, even they are going to be impacting the indices of the market also. And it requires consistent evaluation of the market to identify and buy the understanded assets and sell them in the right time. So this is the general practice which is taken by the stock markets. Even this properties are should be involvement in the proactiveness. That means simply talking about quantitative analysis and diversification. So for that they can understand the business strategies and process well. And one more, this is the process is completely high fees are required. Even if any investor want to take the outside help, so a third party help. So this is a purely high expenditure. Now we are talking about the next one, the passive portfolio management. This type of is a long term investment focusing, and this try to replicate the market returns. So they believe that price of assets always reflect their fundamentals. I think you know already the fundamental technique and investment means fundamental concept and technical concepts. And the next one, if in this passive portfolio management is it's aimed to long-term wealth. Once they invest, they will be wait for a long time to get their returns. Even their motto also simply talking about minimizing the risk and maximizing the profits. That we call returns. The third one is the discriminatory portfolio management. Under this portfolio management, portfolio manager is fully authorized to take the decision of buying and selling of their clients on behalf of. Actually, this is belongs to directly the portfolio manager. He is taking the right of their account holders money and investments. This type of portfolio is suited for only individuals, not for the organization, because the organization has that much of skill. They will be handle their investment by them own. So, but the primary advantage from this area, they're taking the lot of the experts involvement. So by default, they can't take any kind of wrong actions in possible way. So this is the third one. Now we are moving to that fourth one. This is the last one. So non-discriminatory portfolio management, it involves advising clients on whether the investment is good or bad. But most number of the third parties, most number of the portfolio managers follows this process because they are don't like to involvement of the risk from their clients investment. But the managers act as a financial advisor but not execute any trades on behalf of the investor. The clients have fully authorized over their investment besides expect guidance. The primary the primary advantage from this portfolio management is these are allow you to financial expert without giving them a control of investment decision. But however, due to the market condition, this is the external environment. So the portfolio focus very need to be focused very quickly, and they have to wait for their approvals or returns. Of course, this is also a little bit of cost because they are providing the advertising. But even these people's motto also the simple logic because they want to get some information from the experts. So this is the four types of the portfolio management. This is just for what is portfolio management and why it is very important in the present scenario. Okay. So thank you so much for listen. Thank you.